Just like in a casino where the house always wins, the market will always win. But unlike the casino, in the financial market, you're guaranteed to get your share. You just need to understand how it works and understand the cards in your hand. And I'm going to help you. So in this video, I'll answer 3 key questions. First, how does the financial market really work and why is it different from a casino? Second, what do whales know that you don't? And third, how can you actually win consistently without being a trader, without being a genius, and without needing millions to start? And if this helps you see the market differently, hit subscribe, because this is just the beginning. So let's dive in. First things first, how does the financial market really work and why is it different from a casino? People love to say the stock market is just gambling, that it's like Vegas, that you might as well play roulette. But here's the difference. In a casino, the house always wins because the odds are built against you from the start. In the market, the house can win, but you're allowed to be in the house. You can bet with it, not against it. Let me show you with math. Let me give you a real example. Take roulette. There are 38 numbers on the wheel, and only one of them can win if you bet on a single number. So your chance of hitting is 1 in 38, or about 2.6%. And the payout, 35 to 1. Sounds cool, but do the math. Every $1 you bet, you're losing about 5 cents over time. That's the expected return. That's how the house wins. Even slot machines, they pay out on average 90%, which means every dollar you spend, you're burning 10 cents forever. Now let's compare that to the stock market. If you invest in the S&P 500, which is basically the 500 biggest companies in America, your average return over the last 100 years is about 10% per year. So let's look at your odds of winning in the market based on real historical data. If you invest for one day, yeah, it's like a coin toss, 50-50. But hold for 1 year, you've got a 70% chance of making money. Over 5 years, that jumps to almost 90%. And if you stay in for 20 years or more, historically, your odds of losing are basically 0. Let me say that again, 0. Because the longer you stay in the market, the more the odds move in your favor. In a casino, the longer you play, the more you lose. In the stock market, the longer you stay invested, the more you win. That's the difference. The market isn't a slot machine. It's not about guessing or luck. When you invest in stocks, especially long-term, you're buying pieces of real businesses. Companies that make real products, generate real profits, and pay you dividends while you sleep. Like, the casino isn't producing anything new, nor is it innovating like NASDAQ stocks, which transform the global economy. And buying a stock is not gambling. That's owning a part of the economy. It's capitalism. And if you play the game right, you're not just betting on the house, you become the house. That's how the market really works. I know that many people have several criticisms of the financial market, mainly about there being a lot of speculation, but individually, as an investor, you are not obliged to play the speculation game. And in most cases, this is not even the smartest stance. But yes, one of the foundations of the market is competition. Everyone is trying to get a better, bigger slice of the market. Some stand out and earn much more. These are the whales. And moving to the second part of this video, what do whales know that you don't? When I say whales, I'm talking about the big players, Buffett, Dalio, Druckenmiller, Burry, firms like Vanguard, BlackRock, Bridgewater. These guys don't win because they guess better than you. They win because they see the game differently. And one of the biggest things that changes their perspective is how much money they have to move. When you're managing billions, you get 2 huge advantages. First, you get a privileged view of the market because, let's be honest, everyone wants a piece of your capital. Banks want your business. Analysts want your attention. Founders want your money. So these whales don't chase information. Information comes to them. They get invited into deals that the public never sees. They sit in private rooms with decision makers. They get access to data, insights, and partnerships that the average investor will never hear about. That's the power of having capital. People show up with the good stuff. Second, they have dry powder, a war chest of cash, ready to deploy when the market crashes. Take Berkshire Hathaway. As of now, they're sitting on over $300 billion in cash. Why? Because they're waiting for panic, waiting for the market to drop, waiting for you to sell so they can buy. See, most people think small investors sell in a crash because they're stupid, but that's not true. They sell because they need the money. When the market goes down, life usually gets more expensive. Inflation kicks in, layoffs happen, bills pile up, and if you don't have a safety net, you're forced to liquidate your investments. Not because you want to, because you have to. So if you want to play the market like a whale, the first thing you need to do is build your emergency fund. I know, it's boring, it's not sexy, but it's your defense. If you're an adult with bills to pay, having 6 to 12 months of living expenses saved in something safe, like bonds, money market, even a simple savings account, that's not optional. That's your permission to stay invested when things get ugly. Unless you're young and living with your parents, in that case, congrats, they are your emergency fund. But if you're on your own, you need that cushion. And moving now to the third part. After build your emergency fund, how can you actually win consistently without being a trader, without being a genius, and without needing millions to start? First, I'll teach you the complex way, then the simple way. I need to make it very clear that making money in in the market, and beating the market isn't for everyone. To be very honest, most investors would benefit much more if they took the simple path, because the complex path requires commitment, a lot of study, and yes, intelligence. Any of the great whales are dedicated, committed people who love the market, who are obsessed with it, who know how to compete and know how to win. They are very intelligent people. And even following the less complex path and without wanting to become a market expert, you can have good returns. But let's start with the complex way. The first thing major market investors do is choose a stock portfolio. They choose carefully, and at this stage, a mistake many make is choosing too many stocks at once. Be humble. What are the chances of you choosing well from a hyper-diversified portfolio and hitting all your bets? Warren Buffett, the biggest investor, has 36 shares, which I think is a hell of a lot of stocks. Personally, I currently have 13 assets in my public portfolio, 6 of which are stocks, and I have a great team of analysts like Buffett to help me make informed decisions. So I think if you're a beginner or have already been screwed a lot in the market, start by choosing 3 and following the procedures I'll teach you. The first one, follow the company's reports. Let me give you an example. Check out this news from CNBC. Hims & Hers stock falls 10% on revenue miss. Do you know where the investors who started selling first found this information? Another example, in Yahoo Finance, Palantir stock surges after company reports first billion-dollar quarter. This news was taken from a company quarterly report. In other words, the market pays attention to these things and cares about them. They send out email notifications, set dates and times, and wait to act. Every company publishes with a certain regularity earnings reports with updated numbers, projections, and market signals. This is where you see if the company is really delivering what it promised, or if you're just holding on to a dream. That's why you should only keep the stocks whose data you can track in your portfolio, because if you have 36, like Buffett, you'll need a team reading these things for you, often acting on your behalf. And don't worry about reading every footnote like a forensic accountant, but pay attention to the basics: revenue growth, profit margins, debt levels, cash generation, future guidance. Second, watch the macro. Even if your company is great in numbers and reports, the market is cyclical and cycles move prices more than fundamentals. Interest rates, inflation, government policy, commodity prices, all of this shapes the environment your stock lives in. If rates are rising, capital gets expensive and riskier companies bleed. If inflation falls, consumer companies might recover their margins. And if a recession is near, even great businesses can crash, not because they failed, but because fear took over. Look at the market cycle. It starts with accumulation when no one wants to buy, then comes markup when prices surge and confidence returns. Later, distribution when smart money sells to the crowd, and finally, decline, everything falls, even quality. And what drives all this? Signals: falling inflation, interest rate hikes, yield curve inversions, sentiment shifts, narrowing market breadth, rising volatility. You don't need to predict the future, but you need to keep a close eye on what's happening. Every month, the Fed sets rates and releases a job report. You need to at least keep an eye on that. Third, use the internet. Seriously, all the data is out there. Investor relations websites, earnings call transcripts, macroeconomic indicators, industry reports. Everything you need to make better decisions is available for free if you're willing to look. And maybe you just don't want to spend your life doing that. And that's okay. You can still build wealth by taking the simpler path, investing in more conservative, automated ways that pay you the market average over time. One of them is through ETFs, a creation of John Bogle that revolutionized investing for small investors. With ETFs, you don't have to pick the right stocks. You just buy the market. You get exposure to hundreds of companies at once for a fraction of the cost. Historically, this passive strategy beats most active managers over the long run. But even with ETFs, people still mess it up. They panic. They sell during crashes. They buy at the top. They jump from strategy to strategy, chasing what just worked last year. That's why, for many people, the smartest decision is to have a professional by your side. A good financial advisor doesn't just help you choose assets. They help you define goals, principles, understand your risk tolerance, stick to your plan, and most importantly, protect you from your own emotions. And no, that's not just theory. According to a study by Vanguard, investors who work with advisors earn, on average, 3% more per year than those who invest alone. Morningstar's research confirms this too. The biggest value an advisor adds isn't in the picks, it's in the behavior, helping you stay invested, helping you avoid panic, helping you focus on the long term. That 3%, it compounds. Over 30 years, it can mean hundreds of thousands of dollars more in your pocket. So hiring an advisor isn't an expense, it's leverage. Because at the end of the day, investing isn't about being the smartest person in the room. It's about being the one who stays in the game long enough to win.